In this video, I will explain why Apple stock is solid choice for buy and hold investors at its current price levels of around $200 per share before its fiscal year 2025 second quarter earnings report. Apple stock is about to release its fiscal year second quarter earnings report for 2025 in less than a week. It is scheduled on May 1, 2025. The company, together with the overall investing landscape, is experiencing material uncertainties. Here, I will divide these uncertainties into two buckets and analyze their impacts on the stock. The first bucket includes changes that can impact Apple stock's specific operations, particularly the potential changes in tariff rates that can impact Apple stock profitability metrics. The second bucket will include changes that are more macroeconomic and impact the risk premium of Apple stock shares. As you will see, my overall conclusion is that the risks are already priced in, making Apple stock a solid choice for buy and hold accounts at its current price levels of around $200 per share. As you all know, President Trump has announced new trade policies that could impact Apple stock's manufacturing and supply chains. The most crucial element here is that China now faces a much higher tariff on its goods imported to the US. This rate may change as I believe both countries are still keeping the door open for further negations. But even if the current rate is implemented in the near term, it could materially impact Apple stock's profit as a large portion of its manufacturing is based in China. For example, the cost of its iPhones could increase sizably according to various analysts. And a few of them are quoted below. BBC report, April 10, 2025. Following Trump's tariff increase on China to 125%, the cost for a China-made iPhone 16 Pro Max with 256GB storage would have surged from $1,199 to $1,999, according to estimates by investment banking firm UBS. They estimate a less significant increase on the iPhone 16 Pro 128GB storage, which is made in India, by 5% from $999 to $1,046. Even with the loyalty of Apple stock fans, I don't expect Apple stock to be able to fully pass on the additional cost to its customers, and thus I expect a noticeably margin pressure in its Q2 ER. This seems to be the view of the market consensus too. As an example, the chart below describes Apple stock's EPS projection, and my margins estimates. To wit, in the past quarter, Apple stock earned an EPS of $2.40 on a revenue of $124.30 billion. This resulted in an implied net profit margin of 29.3%. Looking ahead to the upcoming ER, the consensus EPS estimate is $1.61, and the revenue estimate is $94.02 billion. Assume the same number of outstanding shares as the last quarter, the implied net profit margin is 25.8% for Q2, translating into a margin compression of 350 basis points. Margin pressure could persist, for reasons to be detailed later. But I think the current valuation has already priced in such pressure already, which leads me to the discussion of the macroeconomic catalysts in the next section. The above geopolitical and trade conflicts, besides impacting Apple stock's specific operations, have also altered a few key macroeconomic parameters. For example, the risk-free rates have decreased noticeably since my last writing. To wit, the chart below depicts the changes in 10-year Treasury rate, I:10-year, since then. As seen, the reading was above 4.6% in February 2025. It dipped to as low as 4% in early April and now hovers around 4.4%. Risk-free rates act as gravity on all asset valuation, and I thus expect the current lower rate to better support for Apple stock's valuation. But Apple stock's valuation has moved in the opposite direction since my last writing. As seen, its earnings yield has increased quite sharply in this period. It started at around 2.8% at the time of my last analysis and climbed to the current level of 3.08%. I believe the above valuation divergence between Apple's earnings yield and risk-free rates already fully factored in the headwinds facing Apple stock ahead. I further believe that A, the above divergence understated the valuation divergence between Apple and risk-free rates, and B, the divergence could be even wider if Apple stock prices remained at the current level, of around $200 as of this writing. The table below illustrates both points. There are a few basic concepts underlying this table, and all are detailed in my earlier articles. Here let me recap the essential ones for the ease of reference. Many investors like to focus on dividend yield and thus compute yield spread using dividend yield. But for long-term investors, earning yield is what's really matters. In the long term, it doesn't matter how the business uses the earnings, paid out cash dividends, retained in its bank account, reinvested, etc. As long as used sensibly, as Apple stock has done in the past, it will be reflected as a return to the business owner. Furthermore, pre-tax earnings yields make better sense for benchmarking against risk-free rates because whenever we speak of bond yield, that yield is quoted as pre-tax yield. These are the reasons my projection below needs to assume Apple stock's effective tax rates. Other assumptions I made here are A. Apple stock future EPS, which I relied on consensus estimates, and B. Future interest rates, which I used the most likely scenario anticipated by the CME Group Fed Watch tool. Based on these inputs, you can see that under current conditions, Apple stock provides a comfortable pre-tax yield spread of 0.7% above Treasury rates. If its price stays around $200, the pre-tax yield spread would further widen to 2.8% in the next 2 years or so, a level too wide to actually happen in my assessment. All told, I expect the tariff conflicts between China and U.S. to impact Apple stock profitability metrics, and such impacts could be felt even in its upcoming Q2 earnings report. However, other catalysts help to counterbalance these impacts. The top catalysts on this side include interest rates, rate cut outlook, and also Apple stock's EPS growth drivers, especially service revenues, which should be relatively insensitive to tariff rates. For these reasons, my overall conclusion is that the risks are already priced in under current conditions, making Apple stock a solid choice for buy and hold accounts at its current price levels of around $200 per share.